Hello and welcome to the IPSASB's deep dive of IPSAS 46 measurement. My name is Dave Warren. I'm the Deputy Director of the IPSASB. And what I'll do today is take you through some key principles and try to provide some insights that the IPSASB had when developing this important pronouncement. So with that, I'll kick us off and I'll take us into this really important webinar. And the way that we have this structured today is to really go through and start with a background and explain why this pronouncement was developed. After that, after we spent a few minutes giving a background and overview, what we'll move into is discussing the structure of this pronouncement and how it interacts with other aspects of the conceptual framework and other IPSAS. And then finally, where I'll spend the bulk of this time on this presentation is to talk through some of the key principles related to IPSAS 46 measurement. So to kick things off, the reason why the IPSASB began this project really goes back to the completion of its conceptual framework in 2014. And the way I like to think of the conceptual framework is it's a sandbox that the IPSASB has created that it's allowed itself to play in developing IPSAS going forward. Sometimes it will dip a toe outside the sandbox, but for the most part, it operates within the principles established in the sandbox. But what became evident coming out of 2014 is the measurement principles established in the conceptual framework weren't completely aligned with the other IPSAS that had been established at that point of time. So what the IPSASB did very quickly was in 2015, approved a project brief for the measurement project to better align the principles throughout IPSAS with its conceptual framework. In addition to what the IPSASB core goal was in aligning the conceptual framework better with the existing IPSAS, what IPSAS measurement aimed to do was to add additional guidance on the key measurement bases that were applied throughout IPSAS. So in the conceptual framework, it identified several measurement bases. Not all were used throughout the IPSAS suite of literature. But what this project was looking to do was identify the ones that were used commonly and provide additional guidance and application guidance on how to use these in practice. The second aspect of this project that constituents asked the IPSASB to look into was really bottom out how to account for transaction costs and borrowing costs. Next, the IPSASB was looking to revise the measurement and disclosure requirements throughout IPSAS as necessary. So assuming that IPSAS 46 made some significant changes to measurement throughout the literature, the IPSASB committed to making those changes through other IPSAS as well. And then finally, if the link from the IPSAS 46 project was to look at other IPSAS, it was also to look the other way as well to make sure that the IPSAS 46 measurement principles align with the conceptual framework. So this last point is really important because what ended up happening with this measurement project is not only was it one individual standard, IPSAS 46, but it also turned into a package of 3 pronouncements. So what you'll see on this slide are the 3 pronouncements that really made up the measurement package of pronouncements. On the far left, you'll see Chapter 7, Measurement of Assets and Liabilities in Financial Statements. And this Chapter 7 is Chapter 7 of the conceptual frame. And it was the IPSASB updating that chapter to reflect changes since 2014 when the conceptual framework was established. The core part of this project, and that's the middle document, IPSAS 46 measurement, is where I'll spend most of the time on this presentation today and going through the key principles. And this really, again, expanded on existing measurement bases that were commonly used in practice. Now, on the far right of this slide, what you'll see is the final component of this measurement suite of pronouncements. And this was IPSAS 45, Property, Plant, and Equipment. And what we saw with this pronouncement was when this project was initiated, the Property, Plant, and Equipment project, it really began with heritage and infrastructure assets. And about halfway through the project, the IPSASB decided that these changes were related to property, plant, and equipment. And in order to reflect the changes appropriately, it was going to require an update to IPSAS 45. Because that project was being updated and IPSAS 45 was being developed, the IPSASB thought it was an excellent time to incorporate the measurement principles that were being proposed in IPSAS 46 also into that IPSAS 45 project. So again, even though today we'll be focusing on IPSAS 46 measurement, this project was much broader and dealt with a number of other aspects throughout the IPSAS suite of literature. So that really takes us to the key takeaways from IPSAS 46. And if I was to touch on, again, the key ones, and I'll go into most of these in more detail as I get into the key principles, but what IPSAS 46 really did was propose the inclusion of fair value into its suite of literature. And this is fair value aligned with IFRS 13. This was strongly supported by our constituents, and those constituents indicated where the public sector transactions were consistent with those in the private sector, it was really important that they be measured in a consistent way. And the prime example and really the genesis of bringing fair value in and having it aligned with IFRS 13 was financial instruments. The view was that financial instruments in the private sector were consistent with those in the public sector, and they should be measured consistently. Now, as a result of bringing in fair value was constituents telling us that even though they strongly supported the incorporation of fair value into the IPSAS suite of standards, if fair value was being brought in, there also needed to be a public sector specific measurement basis developed for current value measures. And I'll talk a lot about both these measurement bases as I move on, but fair value was really developed for, or designed to be applied for assets in the public sector that are held for their financial capacity. And when current operational value was being developed, what the IPSASB really focused on were those assets that were held for their operational capacity. So in the public sector, what you'll see is a number of assets are held to deliver services rather than generate profits. So you'll see hospitals, schools, water treatment centers, those types of assets that make up probably the bulk of public sector assets. We were told a measurement basis needed to be developed in order to address those concerns. The next 2 points I'll touch on quickly because I will deal with these in upcoming slides, but IPSAS 46 was really an overarching standard. It consolidates measurement guidance across the suite of IPSAS and brings it all into one place. IPSAS 46 wasn't a revolution in measurement. It really is an evolution. So in a lot of cases, as I talk through some of the key principles, I'll try to highlight that these aren't changes from existing IPSAS, but again, it's consolidating all this measurement guidance in one place. So you have a one-stop shop. You have one pronouncement that you can turn to and look to determine the appropriate measurement and how to determine that measurement in practice. And then finally, the fourth bullet, and I touched on this before, but what IPSAS 46 did was, in addition to identifying the key measurement bases that existed in IPSAS, it also provided detailed guidance on how to determine those measurement bases, what assumptions need to be taken in practice in order to apply these measurement bases when you're measuring assets and liabilities. At the bottom of this slide, I'll just touch on these links with other components or aspects of the measurement project. So on the bottom left, IPSAS 45, property, plant, and equipment. I touched on this already, but while the property, plant, and equipment project was going on and addressing heritage and infrastructure assets, all the measurement principles that were being developed at the same time were incorporated into the new property, plant, and equipment guidance. So as a result, you have a complete alignment between IPSAS 45 and IPSAS 46. The second aspect at the bottom is application of COV, which is current operational value. And you'll hear a lot more about this, but current operational value is that public sector measurement basis I just referred to. And in finalizing IPSAS 46, COV was incorporated into property, plant, and equipment. But what the IPSASB agreed to do was, upon approving IPSAS 46 in March of 2023, it began a second phase of this project and looked at how, and is currently looking at how COV, current operational value, whether it's applicable in other IPSAS as well. So if you're following that project right now, you'll see IPSASB meetings. IPSASB is going through various pronouncements or various IPSAS to determine whether there needs to be changes made. And then finally, on the bottom right, natural resources. This is an ongoing project. One of the key aspects of this project is measurement of natural resources. So as a result, in applying the natural resource in developing the natural resources principles, what the IPSASB is doing is obviously considering all the new guidance in IPSAS 46 measurement. So that takes us through the really high overview and background of the pronouncement. What I want to do now is spend a couple minutes and explain the structure of IPSAS 46 and how it interacts with other aspects of the IPSASB's framework and standards. So we just saw this slide, but I wanted to put it up again because it really is a good visualization of what I want to talk to in a second. And again, on the far left, we have the conceptual framework. In the middle, we have IPSAS 46 measurement, which is what we'll spend most of our time talking about today. And on the far right, we have IPSAS 45 property, plant, and equipment. So on the far right, I would say your other IPSAS that rely on measurement principles developed in the conceptual framework and the measurement project. So when I move to this next slide, this breaks down each of those pronouncements into a little more detail. So I'll start on the far left with the conceptual framework. And what the conceptual framework did in the update to Chapter 7 is it better aligned what was in the conceptual framework with what was in the actual IPSAS. So back in 2014, the IPSASB developed a number of measurement bases, a number of which weren't actually used in IPSAS. So in updating the conceptual framework, Chapter 7, some of those measurement bases were removed, and the ones that were applied in practice were better explained, and stronger principles that can be applied throughout IPSAS were developed and made more robust in the conceptual framework. The other aspect of the conceptual framework that's new, and I'll talk about this again later in the presentation, is the development of the measurement framework. And that measurement framework really highlights how measurement models, measurement bases, and measurement techniques all work together to provide a robust measurement for those assets and liabilities in your financial statements. So moving out of the conceptual framework and into IPSAS measurement. So I said in developing this, the IPSASB was trying to develop a one-stop shop for measurement. So what IPSAS 46 did was it pulled all the measurement guidance throughout the other IPSAS, the other IPSAS in the IPSASB suite of literature, and brought it into one pronouncement so that if an entity needs to understand how to apply a measurement basis, they can always turn to IPSAS 46 measurement. So what IPSAS 46 measurement does in a little more detail is it defines the key measurement basis, and then it expands more than what's in the conceptual framework. And IPSAS 46 is also authoritative. So it makes it more robust and, again, more applicable across the suite of IPSAS. What's really important, and you'll see this in the boxed area, are the appendices. For each measurement basis that is identified in both the conceptual framework and IPSAS 46, the IPSASB developed an appendix that describes how to apply these measurement bases in practice. So what they are, the key assumptions that are required, and practical considerations that entities need to take when applying these measurement bases to various assets and liabilities. What's really important here is what IPSAS 46 does is it explains to constituents how to determine the measurement basis, how to, again, what assumptions, what characteristics to take into account in practice when you're applying the measurement basis. Now, when I look at the other IPSAS, they still retain measurement guidance, but they don't retain measurement guidance on how to apply the measurement basis. They retain guidance on which measurement basis to apply. So if I go back to property, plant, and equipment allows entities to measure their property, plant, and equipment at historical cost, fair value, and now current operational value. So in IPSAS 45, you'll see guidance allowing you to use any of these measurement bases. But in order to determine how to actually apply these in practice, you'll have to turn back to IPSAS 46. And this is consistent across the suite of standards now. As part of this project, IPSAS 46 pulled the how-to measurement guidance from other IPSAS and consolidated it all within IPSAS 46. So that moves us to the principles that I really want to cover and the key principles. And I'll go through each of the measurement bases and some of the key aspects that our constituents asked us to cover as we were moving through and developing the principles related to this project. So the first key point I wanted to cover was deemed cost. Deemed cost is a good example of evolution of guidance, not revolution. So I wouldn't necessarily say there's anything new there or anything new here with the principles related to deemed cost. But again, what IPSAS 46 did was it consolidated guidance of deemed cost across IPSAS, so you're not getting contradictory principles or different guidance in different standards. So what deemed cost was really doing and what it's outlining is how to determine the value of an asset or a liability, primarily when transaction cost is not an appropriate measure. So in most cases, when you acquire an asset or assume a liability, the most accurate value of that asset or liability when you acquire or assume it is the transaction price. And that's going to be the price that you pay to acquire an asset or you incur to assume a liability. And in most cases, this is the most relevant value because it's going to be a price from an observable market. It's between two third parties and you've negotiated a market price, and that's the most relevant price available. But in some cases, the transaction price doesn't actually reflect the economics of the transaction. And this might occur more often in the public sector because there might be a lack of observable information. There might be more related party transactions. There might be more transactions where the asset or liabilities are exchanged where there's no consideration. So there is no transaction price, or if the transaction price is zero or some nominal amount, like I said, it's not relevant in reflecting the economics of the transaction. So what deemed cost explains is when the transaction price isn't observable, when it's not reflective of the economics of the transaction, the entity is required to use one of the current value measurement bases, fair value, current operational value, or cost of fulfillment to determine or to estimate the value of that asset or liability on inception. The second key point or key principle that I wanted to go through related to a specific ask that our constituents identified when this project was established, and that was transaction costs and borrowing costs. And again, nothing revolutionary here. Again, this is just bringing guidance into one place and making sure it's consistent across the suite of literature. With regards to transaction costs, I mentioned this on the previous slide, but transaction costs are really those costs that are incremental that wouldn't have been incurred if you weren't acquiring an asset or assuming a liability. And what constituents asked was for consistent guidance on whether they should be included or excluded from transactions. And while the IPSAS didn't develop a bright line rule or principle on whether to include or exclude transaction costs when acquiring or assuming liabilities, what the IPSAS did was create a very clear principle indicating that transaction costs are included or excluded depending on the objective of measurement. So in some cases, you might be acquiring an asset and you might want to reflect the cost you incurred to enter into the transaction. So how much did it cost you to acquire a building? So if a building cost you 100 million currency units to acquire, you'd want to reflect that in your financial statements. But any costs associated with acquiring that building, so maybe permits or land transfer tax, those types of costs, those might qualify as transaction costs. And if you're trying to reflect the amount that you paid to enter into the transaction, those would be relevant to include the price. Whereas other measurement bases, such as fair value, for example, you're trying to reflect the amount that you could sell the asset for. So in those cases where you're trying to reflect the amount that it would cost to exit the transaction or you'd receive to exit the transaction, it's not appropriate to include transaction costs you would incur when entering into the transaction. So if you acquired a building again for 100 million currency units and you had some transaction costs associated with that acquisition, those aren't relevant in reflecting how much you could receive to sell that building on the open market. The other point I wanted to touch on this slide is borrowing costs. And again, this was another point where our constituents indicated this was where they wanted more clarity, more consistency on how to apply in practice. So going into the measurement project, and there still is a borrowing cost standard. And what this borrowing cost standard indicated was the entity has a policy choice on whether to capitalize or expense borrowing costs during the development or construction of an asset. And as part of the consultation phase of the measurement project, the IPSAS sought feedback on the appropriate direction to take, whether to continue to allow for the expense of borrowing costs or capitalization of borrowing costs, or whether that policy choice should be removed. And what the IPSAS heard was very split. And this really resulted in the IPSAS seeing there wasn't a strong view in either direction, and the IPSAS thought that was important, and as a result, retained the accounting policy choice to expense or capitalize borrowing costs. Now, what was interesting about this decision was because the steer from constituents was clear and was clear early on, the IPSAS was able to bifurcate borrowing costs from the broader measurement project and issued guidance a few years ago, confirming this retention of the policy choice and also adding additional guidance to the borrowing cost pronouncement, explaining how to apply borrowing costs in practice. So just providing more practical examples, but not updating or changing any of the principles. So I only highlight that because you won't actually see the borrowing cost guidance as part of the measurement project because, like I said, there was a clear steer from constituents, and the IPSAS was able to address that earlier in the project and address that separately. As we move into the measurement basis, what I wanted to touch on first was the measurement framework and highlight the IPSAS methodology and thinking in designing the framework and how this framework applies across its suite of literature. So you'll see the measurement framework initially discussed in Chapter 7 of the conceptual framework, but then discussed in a more robust way as part of IPSAS 46 measurement. As part of the framework, there are 3 key levels. So the first one is your measurement models. And your measurement models are really there to present the objective of measurement. So are you trying to present your assets and liabilities on a historical basis, or are you trying to present them on a current value basis? And this is important because whether you use a historical cost model or a current value model, you're presenting very different information to the users of the financial information. And neither is right nor wrong, but they're different, and the individual entity might have different objectives in presenting that information. So if the entity wants to use a historical cost model, what they're presenting is, if I focus on an asset and I go back to the building that was acquired for 100 million currency units, if that's under the historical cost model, you're presenting that building based on the price that was paid to acquire that asset. And that's what is presented on your balance sheet. And any amortization related to that building that was acquired represents the cost in the current period based on the price paid when the building was acquired. That's very different than the current value model that will revalue the building that I was highlighting at every reporting date. So that means your value on your balance sheet is going to change and reflect the current value of the building. But it also shows in your statement of surplus and deficit, the amortization will be based on the current cost of the building. So as a result, you're reflecting the current, or you're estimating the current operation costs based on the current cost of the building. So again, an entity has the ability to select its model, but what the models are doing are presenting very different objectives in measure. Now, below models are bases, and bases are available and present different ways for entities to present information in the model. So what I mean by that is in the historical cost model, there's only the historical cost basis. So the IPSAS didn't identify different ways to present historical cost information. But as I move to the current value model, you'll see that the IPSAS highlighted there's current operational value, which is available for assets. That's the public sector specific measurement basis. There's cost of fulfillment, which is available for liabilities. And then there's fair value, which is available for assets and liabilities. And while all three sit under the current value model, they all present current information differently. And a really quick example is current operational value, and we'll get into this in more detail, is reflecting the value of the asset to the entity, whereas fair value is presenting that same current value of the asset, but it's the value to a market participant. So again, both sit under the current value model, both are being updated on a continual basis, but they're presenting different types of information that might have different uses to users. And then finally, the third level of the subsequent measurement framework are measurement techniques. And measurement techniques are ways to estimate the measurement bases that are being presented. So nothing under the historical cost model, but under the current value model, you'll see that different techniques are available. So under current operational value, you'll see that the market or cost approach is available. Under cost of fulfillment, the income approach is available. And then under fair value, market cost or income is available. And I won't touch too much on these techniques, but the market technique or the market approach really looks at what market information is available in the market. So again, if I focus on assets, how much would you incur if you went to the market, or how much could you sell the asset for in the market? Whereas cost is looking at how much it would cost to replace that asset. If you weren't able to operate it anymore, you had to replace it in practice. And then income approach is looking at the expected cash flows associated with the asset or liability and discounting those back to today's value. So again, depending on which measurement basis you use and what you're trying to reflect, different measurement techniques might be appropriate to best represent the measurement basis. I suspect in practice, while you always have the choice on which measurement technique to use, I suspect the information available is more likely what's going to determine which measurement technique you'll apply. So if you have an asset that has cash flows associated, it might be the easiest to use the income approach. Whereas if you have a market associated with that asset, it might be more likely you use the market approach. So again, the selection of measurement techniques, I think, will lie more in the information available associated with that asset or liability. So now that we've gone through the subsequent measurement framework, I want to touch on each of these measurement bases individually. So I've said this before, but historical cost is a good example where this is existing guidance that existed throughout IPSAS, and what IPSAS 46 and Chapter 7 of the conceptual framework did was just consolidate this guidance and make sure that terminology was aligned and was consistent now as it all sits in one place. And historical cost, as I'm sure you're familiar with, is the consideration that was paid to acquire an asset or received to assume a liability at the historical date when the transaction occurred. And some of the key principles that are related to historical cost are that historical cost really relates to assets and liabilities, as noted in the definition. One of the key points here, and you won't see this in the other three measurement bases that I'm going to go through, is historical cost is a historical measure. It looks at historical market conditions. What historical cost is trying to do is present measurement information based on facts and circumstances that were in place when the event or transaction occurred. So as I noted in the example on the previous slide, if you're acquiring a building for 100 million currency units, that's sitting on your balance sheet at the historical cost, less any amortization. And then that amortization in your surplus or deficit is based on the transaction price at the date that the event or transaction occurred. The only other point that I'll touch on principles is the final one on the bottom right, and that historical cost is an entry value. So as a result, this is one of the instances where the IPSAS was clear that they believe transaction costs should be included as part of the acquisition of the asset and included as part of the value of the liability as well. Next, we move to fair value. And as I noted with fair value was formally incorporated into the IPSAS suite of literature as part of the IPSAS 46 project. It is aligned completely with IFRS 13, and that was strongly supported by constituents both in the consultation paper and exposure draft, because they felt that where private sector transactions were the same as public sector transactions, they should be measured the same way. And again, I know I mentioned this, but financial instruments was really the genesis of this view. And the view was that if you have a bond in the private sector, it should be valued the same way as a bond in the public sector. The characteristics are similar and consistent, and as a result, for comparability, it was important to have the same measurement basis available. Now, fair value itself is the value that, or the price that would be paid to sell an asset, or the amount that would be received to transfer a liability. So what you'll see here is, again, I've highlighted a number of principles. As it relates to fair value, you'll see that it relates to assets or liabilities. And then one really key point is the second box, and that's highest and best use. And I say this is really important because you'll see a contrast when I move to the next slide on current operational value. So fair value requires that you consider the highest and best use of an asset when you're trying to determine the price that you receive to sell that asset. And what that means is, if you have your building that you acquired and you acquired it some time ago, regardless of how you're using it now, when you're trying to determine the value that you could sell that building for, you look to the market and determine what the market would yield if you were to sell that asset. And that building might be used in a different way than how the entity is currently using it, but that's the value, that's the highest and best use as it relates to fair value. So as an example, in the public sector, they may operate a building that's being used as a school, but if it was to sell that building in the open market, the market might use that building for something completely different. It might use it as residential space or commercial space, and that might change the value as it compared to its value being used as a school. The other points really focus on, so orderly transaction and market participant are really focusing on the fact this isn't an entity specific value. It's really focusing on the value of the asset, or the amount received to or the amount paid to transfer a liability with a market participant. So what would a party at arm's length either pay you to receive an asset, or you'd have to pay them to transfer your liability? And then finally, fair value is an exit value. So this is the amount you'd receive to sell an asset, not acquire an asset, and then transfer a liability, not assume a liability. Now, the reason why fair value leads really well into current operational value is both were strongly supported by constituents, but when constituents supported fair value, they indicated that if fair value is brought in, because it really relates to those assets that are held for their financial capacity, and they indicated that financial capacity assets were consistent in the public sector and the private sector, so it made sense to use fair value. In the public sector, there is potentially the majority of assets that are held for their service capacity or operational capacity. And they didn't believe that fair value fairly reflected the value of assets that are held for their service capacity. So for those assets that are held to provide educational services or healthcare services, so hospitals or schools, the financial capacity associated with those assets wasn't relevant, because public sector entities aren't necessarily holding the majority of their assets for for financial capacity needs. So as a result, current operational value was developed, and it really focuses on the amount the entity would pay for the remaining service potential of an asset at the measurement date. Again, going back to the principles, a few key differences between current operational value and fair value is, the first box is current operational value is designed solely for assets. This differs in the fair value that relates to assets and liabilities. And then a key difference that I always like to highlight between current operational value and fair value is, I talked a lot about highest and best use as it relates to fair value. But when I look at current operational value and I look at the first three principles, existing asset, existing use, and existing location, the key difference between current operational value and fair value is fair value focuses on the value of the asset to a third party. What could you receive to sell that asset? Whereas current operational value is looking at the value of the asset in its existing use, how the entity is using it, what's the value to the entity. So if I use an example of a school, so the school is being operated in a building, that fair value would be based on what the value could be, what the building could be sold for in the open market. Whereas current operational value looks at the value of the building in its current use. So what's the value of the building being used as a school? And that is a very key difference between current operational value and fair value, because the lens in which you are trying to reflect the information or the measurement information provides very different information to users of financial statements. And this was key, and one of the reasons that current operational value was developed. The IPSAS discussed a number of examples, but often it came back to schools in major metropolitan areas where the value, if it was being fair value, would go up and down based on market conditions. And a number of constituents didn't think that volatility appropriately reflected the value of the asset to citizens in the jurisdiction, and then a more appropriate reflection would exclude the market volatility and really just include or reflect the value of the asset in its current use. And that's really what current operational value is trying to reflect. The only other 2 points are this is an entry price, so as opposed to fair value that looks at what the value of the asset or liability is on exiting the transaction. The entry price with assets is the amount incurred to acquire the asset. And then the last principle, least costly manner. When determining the current operational value, you are expected to determine current operational value based on the cost being incurred in the least costly manner. So if an entity has to replace the building that the school is in, maybe it can look to build it itself, or it can acquire it in the open market. And the least costly manner between those two options is the way that the principles in current operational value are expected to be applied in practice. The last measurement basis that I wanted to go through relates to cost of fulfillment. And cost of fulfillment, as opposed to current operational value, really focuses on a liability measure. Cost of fulfillment, again, similar to historical cost, is really just pulling guidance across the literature and consolidating it into IPSAS 46, and making the principles more robust and stating them more clearly. So as I mentioned, it is a liability measure. And going back to the definition, the cost of fulfillment is really focusing on the amount the entity would incur to settle its own obligations. So what's really important here is, if you're comparing cost of fulfillment to fair value, cost of fulfillment is looking to how much it will cost to settle the liability, versus fair value looks at how much it would cost to transfer the liability. So under cost of fulfillment, if an entity has a loan with a financial institution, they borrowed 100 currency units, cost of fulfillment would require the measurement based on how much the entity would have to incur to settle that obligation with the financial institution. Whereas fair value, that exact same transaction where they borrowed 100 currency units from a financial institution, you wouldn't measure the fair value based on how much the entity would have to pay to settle with the financial institution, but how much they would have to pay to transfer that obligation to another entity willing to take that on. So that's a really key difference. And again, goes back to really the lens in which cost of fulfillment is being reflected versus fair value. I don't have a lot to say on this last slide. This last slide really just compares all the principles across the measurement basis. I've tried to touch on the key ones across each of the individual 4 slides. What I've noticed is where a number of constituents have highlighted is the most useful are the first 2 columns, so fair value and current operational value. They really like to understand the difference between these two measurement bases as it really relates to the operational value and versus the financial value of an asset. And again, I'll just highlight the second to bottom row, which is highest and best use. And that's a very key difference between both fair value and current operational value. With that, I'll start to wrap things up. IPSAS 46, along with IPSAS 45 and Chapter 7 of the Conceptual Framework, were all issued at the end of May of 2023. IPSAS 46 and IPSAS 45 are effective on January 1st, 2025. So while it may seem like a long way out now, it will come, I'm sure, sooner than expected. And I'd say, especially with measurement, there's a number of resources available on the IPSASB's website, www.ipsasb.org. And there you'll find an at a glance, which gives an overview. There's a short overview video. There's this video again that we just went through that goes into more depth, but there's also additional supporting material that makes comparisons between existing guidance in IPSAS and what's in IPSAS 46, and also the fair value comparison between IFRS 13 and IPSAS 46 measurement, which again are aligned, but if you want to see where the paragraphs are and how they line up, that's all available on the website. So with that, I'll thank you very much for attending our webinar today. I hope it was useful and really a good starting step in moving into IPSAS 46. I really wanted to highlight some of the key principles and the structure and how IPSAS 46 interacted with other IPSAS that currently exist. So again, thank you very much for your time today. I really hope it helped, and good luck with implementation of IPSAS 46.